everyone. Welcome to Capital Insider Podcast. I'm Ellie Perlman, your host. I'm the founder and CEO of Blue Lake Capital, and we own multifamily with investors. We buy apartment buildings throughout the US. We build business plans, improve NOI, and then sell. And we do it with investors, and this is something that I'm passionate about. I love it, and I've had some very interesting stories throughout the years that I'm happy to share. But today I want to talk about a little bit of a technical topic, which is essentially interest rates. We're all interested in knowing when interest rates are going to go down, and investors, some people are waiting for that to happen, but I don't think they should be holding their breath. So let's get to it. Okay, so where are we today? When it comes to interest rates, the 10-year Treasury is today, which I'm recording, it's July 16, 2026, is sitting around 4.6, 4.55. And many multifamily loans today are priced between 5.5 and 5.7 percent. And so this is essentially where we are today. And the interesting thing is that I keep hearing from owners and from investors that they're waiting for interest rates to go down. And even though that could be a very nice bonus for us as owners, I think that we're pretty much where we would, we landed where we would be in the foreseeable future. And so if you look at kind of history, and I always like to go back to it, and I'm a huge data person, and I like to look at data and make conclusions and assumptions based on that. But Freddie Mac essentially looked at the historic mortgage rates since 1970. And over the past 50, 60 years, the average was 7.7%. So today's 6.5% are actually lower than 5, 6 decades average interest rate. And so, what I think is that back in 2020, 2021, when, we were at a 3% interest rate environment, that was the anomaly. That was not normal. And so, yes, compared to that, 6.5 is very high, but that's maybe in absolute terms, but if you put the context of where interest rates were in the past 6 decades, you basically understand that we're back to where we're supposed to be. That's pretty normal for real estate. And so back in 2020, the feds, they hit the emergency button during the pandemic, and a lot of owners got very cheap debt. And essentially, a lot of them are also paying the price today, but that was the lowest ever recorded interest rate in history, at least over 50 years of data. And so these days are not, I don't think they're going to come back. Maybe when I'm gray and old, couple of, give me a few more decades, maybe. Um, but that was the anomaly. And that's not today. And so if you're sitting on the sidelines and you're waiting for interest rates to go down close to where it was, I would not hold my breath. You're going to be sitting for a long, long, long time because real estate interest rate just went back to where it was. This is pretty normal. That's my opinion, at least. And maybe I'm going to be mistaken. I want interest rates to go down because that has also an impact on cost of living, which means that more of my tenants can pay on time. It means that my contract services, all my expenses, especially the controllable expenses on my assets, which could be, from utilities to paying for, painting an apartment, etc. Everything is being impacted by it. So my expenses will go down. So I want that to happen. I just don't think it would happen in the near future, not in a meaningful way. But despite that, and what's happening with interest rates, cap rates may not stay the same, even though I think we're pretty much stable when it comes to interest rates. And I have to say that, and I've said it before, I was hoping that with new leadership in the Federal Reserves that interest rates would go down. And I was actually surprised to see that the new head of the Feds is kind of keeping interest rates as is. That was unexpected. I thought that we're going to see a very aggressive rate cuts, but cap rates, in my opinion, are not going to be directly impacted by interest rates, not in the way that many people think. So there's a misconception that cap rates and interest rates are tied, and when interest rates move and they go down, then cap rates compress as well. But again, if you look at a history, if you look at the data, you'll see that this is not always the case. Many times, essentially, cap rates went the other way. And so, yes, there is a correlation. There's some connection between interest rates and cap rates, but that's just one third, I would say, of the entire formula. And so there are a few things that impact cap rate movements, and interest rates are one of those. But you also have rent growth, for example. And so where rents are growing, then buyers are willing to pay a higher price because they believe the valuations are going to go up. So they're willing to pay a little bit more for value that is not there today, which means that cap rates are going to compress. Their cap rates would go up if they think that there's no rent growth, and pretty much NOI is going to stay the same or maybe go down a bit because expenses will go up over time, but income is not going to go up as much. And so rent growth is a big factor when it comes to cap rates. And where we are today, which is really interesting, I would say the past 2 years have been challenging in many markets to grow rents. And a big part of it is cost of living. I think, that went up with inflation. So a lot of renters cannot really pay higher rents. But the other part of it is essentially new construction. And I've talked about that on the podcast ad nauseum. I talk about it a lot. It's actually something I'm very passionate about because it's kind of chicken and the egg, and it's cyclical. Because multifamily rents went up, that attracted a lot of developers to build new buildings to charge top dollars. More get into in the market. Now it's a race to the bottom because renters have a lot of options, a lot of competitors. Because the race at the bottom, everyone is trying to adjust their pricing down to be competitive, to keep units occupied. Then new developers looking at the market, looking at the higher cost of labor and materials, looking at all the tariffs they're going to have to pay, and they're looking at the income that the building would generate, whether they hold it after they complete the construction or they want to sell it. And now it doesn't make economic sense anymore. So there's fewer and fewer units coming in the market. And that's where we are right now, where in many markets, there's almost nothing coming in terms of new developments, new apartment buildings in the next couple of years. And so that means that once that happens, then rents are going to start going up. And we already see that in some markets, by the way. We're able to push rents 5% in some markets. And those are specifically the markets where there's not a lot of competition, not a lot of new construction coming online. And so when it comes to cap rates, rent growth, in addition to interest rates, are another point that essentially impacts their movement. And the third one is the availability of cash. There's a lot of cash chasing deals for all kinds of reasons. There's more competition than, if there's billions of dollars chasing the same product, then you're willing, in order to win a deal, you're willing to take lower yields and you're raising your rents in order to win it. And so those three things are impacting cap rates: interest rates, rent growth, and the availability of cash. And if you look at a history, it would actually show you that multiple times interest rates went one way, cap rates went the other way. And so between 2004, for instance, and 2006, the Feds, they raised the rates by about or more than, 4 points. However, cap rates went down instead of going up. And the reason for that was because there was so much capital chasing deals, chasing apartments, that like I mentioned earlier, when you have a lot of competition, buyers just accepted lower yields and they kept increasing their rent. So the wall of money actually beat the feds. And so that's, one example of how interest rates could have impacted cap rates, but one of the other three factors actually impacted it a bit more. And so when capital is going to come back to the sector, and right now with multifamily, it's starting to come back, the same thing would happen at today's rates because we will see an increase in rent growth. And that would happen pretty soon, whether it's in the next 6, 12, 18 months, depending, of course, on the market. And a lot of institutions will keep deploying to multifamily. Many of them don't do it today, but they will come back. And so the availability of capital would improve. And those two factors, even one of them alone, is strong enough to beat the interest rate component or the interest rate factor. Also, if you look at early 80s, from 1980 to 1985, cap rates were actually sitting below the Treasury yield for the entire 5-year period. And that was, while that was happening, apartments appreciated 6% year over year, which was kind of contrary to what was happening with treasuries. Essentially, what happened is that investors accepted less yield than a government bond because they were getting one thing from real estate that they did not get from a government bond, and that's protection against inflation. Real estate is a great hedge against inflation, and that is something you can get from many other vehicles, including government bonds. And so tying cap rates to interest rates is not always going to work. There are other forces that are part of this, which is why I think that cap rates are probably going to compress. Nobody really knows, right, by how much. I don't think I'm ever in my lifetime, at least, or at least maybe when I hit 70, maybe. But I don't think we're going to see another 3% cap rate environment. But in many markets, deals are trading between 5 and 6% cap. It's very, very likely that we're going to see in the next 2 to 3 years an environment with 4 to 4.5 cap. I really think that would happen as fewer and fewer new projects are going to emerge. Rents are going to go up, and dry powder is going to move and allocate towards multifamily. That combination is going to be very, very powerful. So I think it's important to understand kind of the interest rate environment, but also just bear in mind it doesn't mean that valuations are going to go down or stay flat between now, and in the near future of the next, 2 to 3 years. Now, if we kind of go back to interest rates, any movement, whether interest rates go up or down, that impacts owners and buyers in a different way. So let's say, if interest rates, and I am very positive in my nature, I tend to look at the glass half full. And so let's say interest rates do drop. Let's say it's drop, 100 basis points, 150 basis points, right? So 1 to 1.5%. And now we're about 4.5% interest rate. If you're in a market to buy multifamily, the market is going to move fast because everyone is going to rush back and deploy capital. Cost of borrowing is also going to be obviously cheaper. And then we're going to start seeing the bidding war happening again, just like we've seen it in 2020. Um, and everyone who bought before rates went down, they're going to be viewed as those who have bought at the bottom and as geniuses, which, hindsight is always 2020, right? A lot of money is going to move and fast to buy multifamily. So if you own a portfolio right now and you're experiencing, or we are as a market, we're experiencing a rate cut, then that could be a great thing for you. Sometimes, in order to see some savings and some movements on debt payments, you need a bigger shift. But what happens is that now the interest rates are going down, then as an owner, whether you're passive or active investor, you're going to pay less, obviously, in debt payments. If you're in cash management, which means that the lender is holding the cash flow as a backup, that can get released. And so sometimes, if the environment is favorable enough, you can even refinance and put cheaper debt instead of the current debt. Even if you're very lucky, you can even do a cash out refi, which means that you can refinance, take some money out because there's a positive delta between the new debt and the old debt. And the cherry on top is that you don't even have to pay any gains, any capital gains tax or any tax on it because this is technically not profit. These are loan proceeds. So that's what happens if you own real estate that you plan on holding during a rate cut. Now, when it comes to exits, cheaper debt means that every buyer can actually pay more because they can leverage more. So exits can, prices on the back end, they can grow. I mean, prices can grow by tens of millions of dollars. That would be a home run. When someone can buy your asset and pay, let's say, 4.5% rate instead of 5.5%, it means that in order to get a decent yield, they can now put 5 million more and to be competitive because now there's also, remember, a lot more people, a lot more groups that are competing. And so that's also a pretty much, a home run. So when interest rates are going down, if you own real estate, you can refi or get out of cash management or increase your cash flow. Um, if you're exiting, great time to do that because you're maximizing your exit price. But if you're on the buyer side, you're now paying a premium. You're paying a premium because cost of a debt is cheaper, which means you can leverage more and offer more, and the deal's still going to look good, at least on paper. And so that's kind of interesting between the three different owner groups. Now, what happens when interest rates, let's say they go up by half a point. So now we're sitting half a point to a point, let's say we're sitting around 6.75, 7% interest rate. So when it comes to buyers, when they're looking at deals and trying to size up the loan, lenders, they cut the loan sizes. And that could be on, let's say, $50 million deal. Now they're going to lend you only 30 million, for instance, instead of, I'm just throwing a number out there, instead of 35 million. And so because the loan proceeds are lower, you need to come up with more equity than before. And so now you need to feed more investors, to feed more dollars, which means that everyone gets less. So when that happens, many times deals don't pan out because you just have too much equity in the deal, or you need to raise a lot of equity and not leverage as much, and that impacts returns. And so many times there's a forced sale, like I mentioned, I think at the beginning of this podcast episode, which can create a tremendous amount of, this is a tremendous ability to seize an opportunity. This is where fortunes are being made, where you buy 50, 60 cents on a dollar compared to the peak, pricing. And these are the deals that we see today in the market. So with new acquisitions, things can get tighter. Forced sales and distress situations are the best opportunities to move forward. Now, on your current portfolio, if you have fixed rate loan, then an interest hike is not going to change much for you because you already locked in a lower, interest. I would say that there's a an indirect impact because interest rates, higher interest rates means that cost of living is higher, so your tenants maybe are a little bit more late to pay, maybe bad debt is a bit higher, and the cost of services and software, etc., everything kind of goes up with it. If you have a floating rate, Many deals can turn into cash flow negative unless you have some reserves that you can use. And in those scenarios, in a scenario where interest rates are going up, it makes it very, very hard to exit because it doesn't make sense for many buyers to buy because it needs a lot more, like I said, a lot more equity. So returns are lower. And so valuations are kind of down and you don't really have, many options. So many times there's some bidders that pay only cash, but these are not institutional quality assets. We're talking about, $2 to $5 million. Values many times drop. And what owners do, they extend the loans. And so they hold everything until valuations, cap rates, are in a better place. So if you don't have to sell anything right now, just don't at a time when interest rates are going up, selling is most likely not your best option. And so it could be the same building, same tenant, same location, but different time zones. When interest rates is X or interest rate is Y, that can definitely impact um your position, what you should be doing, whether you should hold, whether you should sell, etc. But I want to tie it back to what I said earlier, which is that could be the case generally speaking, but there might be other forces that can come in and can change things. And just as a reminder, besides interest rates, you have rent growth and you have the availability of capital in the market. Right now, the last two are not extremely strong. So interest rates have more of an impact on cap rates. But once the other two are going to come into play, this analysis that I just gave you may be a bit more nuanced because it could be true, but once you can underwrite increase in rent growth and increase in NOI, then even in a pretty high compared to 2020 interest rate environment, it would still make sense. But I wanted to kind of give you a comparison of the three different groups, whether you own real estate right now and you're holding, whether you're thinking about exiting, whether you want to buy, or maybe you're all three, how different interest rate environments may impact your situation, what you should be doing, but also bear in mind that there are other market forces that will come to play. And in my opinion, in the next 2 to 4 quarters, that may change the landscape of the best business plan and the best move for you. And so I would say, and kind of going back to also how I started the conversation today, I really don't think you should wait for any interest rate cuts because this is kind of normal. This is normal if we're looking at the last 55, 60 years. This is very normal. We're not going to see another 3% interest rates. And I think we may see lower interest rates than what we see today, but this is pretty normal. So what you can do is focus on operations, focus on improving the fundamentals. And of course, I want interest rates to go down, but I think that this is the new normal. It's not the new normal. This is the normal that has been before. The way that interest rates move, many times it dictates how real estate is transacting. But again, you have other things that impact what's happening in the market. And I've seen how markets move really, really quickly. And so back in 2020, there was feeling that I remember I had a conversation with one of our partners and I said, it feels like it's one big party. And one day all of this will end and just didn't know when. And so things will change. They always do. And as long as the fundamentals are solid, the demand is there, fewer and fewer new assets are coming to market, and home affordability is still an issue and it's getting worse every year. Then that's why I still believe in multifamily. And I'm a bit of a contrarian. And, right now you can buy assets at an extremely low price. And we're picking up deals that are distressed and just make a lot of sense. And we're kind of buying at the right base, which makes me excited. That's it for today, guys. Take care. And I hope that I'd added some value. Wanted to just present a different perspective, slightly different perspective about interest rates and cap rates, and share how I see the correlation or lack of between the two. Have a good one. Thank you, guys.